Hello, guys, this is CR Jane, and welcome back to my revision series where I'm going to revise every audit chapter for you guys to help you in your exams a little better. So, let's get started. Today, we are going to take up the second chapter, Rules and Regulation. We have already covered the first chapter, you can watch the video. So, let's begin. Okay, first, a question for you guys. Why do auditors even need regulation? Well, over the last 30 years, the role of auditors has been heavily questioned because of some major audit failures. The most famous case is you should remember for the exam is Enron and its auditor Arthur Anderson. They will not definitely ask you for the name of the case or Arthur Anderson, but it's one of the most famous cases in the accounting field. So, when Enron collapsed, it seriously damaged public trust in auditors. So, regulators around the world had to step in and strengthen the rules. To rebuild the trust, regulators introduced three major initiatives. First, harmonization of auditing procedures. This basically means audit should follow similar standards across the world so users can trust audit reports no matter where the company is located. Second, focus on audit quality. Audit must actually meet the expectations of users, not just be a formality. Third, a strict ethical code of conduct. This helps auditors ensure and remain independent and unbiased. Now, the question is uh, how do auditors actually follow these rules? Practitioners must comply with three main sources of regulation. First, the national corporate law, such as the Companies Act 2006 in the UK or the Sarbanes Oxley Act in the US. Second, auditing standards, mainly the International Standards on Auditings, also called the ISAs. And third, the Code of Ethics, which gives auditors guides on professional behavior and independence. Now, moving on to legal requirements for audits and auditors. Okay, sorry, I yes. Most examples in the syllabus are based on UK law, specifically the Companies Act 2006. But don't worry, the basic principles are similar across most countries. National law mainly determines three things. First, which companies must have an audit. Second, who is allowed or not allowed to perform an audit. And third, rules, regulations regarding audit opinion and resignation and removal, and the duties and rights of the auditor. So, now let's move on to an important question in audit regulation. Who actually needs an audit and why? In most countries, companies are legally required by law to have an audit. This requirement usually comes from national corporate law, such as the Companies Act in the UK. But here's something interesting: not every company must have an audit. Many small or owner managed companies are exempt from audits. The main reason is that audit provide less value in small companies. Let's quickly go through the reasons. First, in many small businesses, the owners and managers are the same people. So the people preparing the financial statements are also the people using them. Because of this, there is less need for an independent auditor to provide assurance. Second, accountants usually add more value to small business through other services such as accounting support, tax advice, or financial planning rather than performing an audit. Third, the impact of mistakes in the financial statement of small companies is unlikely to affect the wider economy. In other words, even if there is a misstatement, it usually does not create a big economic risk. And finally, audits can be expensive and disruptive. For small companies, the audit fee and time involved may be simply to be costly compared to the benefits they receive. However, there is an important exception here. Even if a company is small, audit exemptions usually do not apply to companies in regulated sectors. For example, financial service companies or companies listed on a stock exchange. These companies deal with public money and investor confidence, so audits are usually mandatory. Now let's move to the next part. Who acts as an auditor? Not just anyone can wake up one day and decide to audit companies. To be eligible to act as an auditor, a person must meet certain professional requirements. Generally, the person must be a member of recognized supervisory body, often called as RSB. A good example of this is ACCA. But simply being a member is not always enough. The person must also be allowed by the rules of that body to perform audit work. Another possibility is that the person is directly authorized by the state. Now let's talk about who can actually conduct audit work. Individuals who are authorized to perform audits can work in several different structures. For example, they may be a sole practitioner, meaning they run their own practice, partners in a partnership, members of a limited liability partnership, or a director of an audit company. So auditors can work independently or within firms depending on the structure. But there are also rules about the firm itself. To offer audit services, the firm must either be controlled by members of suitably authorized supervisory body or be directly authorized by the state. This ensures that audit firms themselves are properly regulated. One, fin- one final point to remember for the exam: in some countries, only individuals can be authorized to act as auditors rather than the firm as a whole. So regulation between countries, can vary slightly between countries, but the overall principle remains the same. So let's move on to another area. Who may not act as an auditor? Just like there are rules about who can act as an auditor, there are some clear rules about who cannot perform an audit. First, some people are excluded by law. In most countries, the law does not allow people who manage or work for the company to act as its auditor. Think about it for a second. If you are part of the management team, can you really give an independent opinion on the company's financial statement? Probably not. Oh, what did I do? Yeah. That's why employees, directors, and people closely involved in the company's management cannot audit that company. The law is usually excludes people who have close business or personal relationship with the company's management. Again, there is a the reason is simple: independence. If an auditor has strong personal or financial connections with the company, their judgment could be biased. Now, apart from the law, auditors must also follow something very important: the code of ethics. The code of ethics requires auditors to think carefully about whether anything might prevent them from accepting an audit engagement. For example, the auditors must consider issues like independence. Are they truly objective? Competence. Do they have the skills and knowledge to perform the audit? Confidentiality. Can they protect the sensitive client information? If any of these ethical principles are threatened, the auditor may not be allowed to act as the auditor. We'll actually study this in much more detail in the later on chapters, which is and is a important area for the exam. Now let's talk about who appoints the auditor. The main people responsible for appointing an auditor are the members or shareholders of the company. They appoint the auditor by voting at a general meeting. But sometimes sometimes the directors can also appoint the auditor. This usually happens in two situations. First, when the first auditor of the company needs to be appointed, and second, when there is something called a casual vacancy. A casual vacancy happens when the existing auditor resigns or is removed before the end of their term. However, even when directors appoint an auditor, this appointment normally needs approval from the members at a members' meeting. In some countries, directors may appoint auditors as a routine matter depending on local regulations. If neither the members nor the directors appoint the auditor, the Secretary of State will step in and appoint one. Another small point to remember for the exam is the difference between public and private companies. For public companies, auditors are usually appointed from one AGM to the next AGM, and for private companies, auditors are generally appointed until they are formally removed. Now let's discuss about removing of the auditor. The rules for removing an auditor are designed very carefully. Why? Because auditors must have secure tenure in order to stay independent from management. If management could remove the auditor easily whenever they wanted, the auditor might feel pressured to avoid reporting problems. So the law tries to balance two things. First, the auditor must have enough job security to remain independent, and second, the company must still be able to remove the auditor if they are not performing their duties properly. Usually, removing an auditor requires a simple majority vote at a general meeting of the company. However, there are certain safeguards in place. For example, the company must give a specified notice before proposing the resolution to remove the auditor. This prevents a company from suddenly proposing removal at the last minute to manipulate the vote. Another protection for auditors is that they are allowed to circulate written representations to the shareholders. This means that the auditor can explain why they believe that they should not be removed if necessary. In addition, the auditor leaves their position a statement of circumstance must be sent to the company and the regulatory authority. This statement explains the reason behind the auditor's departure, ensuring transparency. Finally, let's talk about resigning as an auditor. In real life, if the relationship between the management and the auditor becomes difficult, the auditor will often choose to resign voluntarily. When the auditor resigns, they must provide written notice of their resignation. They must also send a statement of circumstances to the members of the company and the relevant regulatory authority. This ensures that shareholders and regulators are aware of any issues surrounding the resignation. Now, if an auditor resigns or is removed before the end of their term, they must notify ACCA. This is important because ACCA is a professional body supervising its members. So, if an auditor leaves an engagement early, ACCA needs to know why it happened, especially if there were any serious issues with the company or the management. Now, let's talk about the auditor's responsibilities when they resign or are removed. The specific rules may vary from country to country, but the basic principles are very similar worldwide. Under typical regulations, for example, under UK law, the auditor must deposit certain documents as a at the company's registered office. These documents include either a statement of circumstance connected with the resignation or removal, or a statement confirming that there are no such circumstances. Uh, and in simple terms, the auditor must clarify whether there were any problems or disagreements that led to their departure. This promotes transparency, especially for shareholders and regulators. Another important responsibility is that the auditor must deal promptly with requests for clearance from new auditors. Now you might be wondering, why does the clearance uh, mean here? When a new auditor is about to accept an audit engagement, they usually contact the previous auditor to ask if there are any professional reasons why they should not accept their appointment. So the previous auditor must respond honestly and promptly to these requests. Okay, let's move on to the next topic, which is the auditor's rights. Auditors are given several legal rights so that they can perform their work effectively and independently. First, the auditor has the right to receive all the information. Um, the auditor has the right to access the company's books and records at any reasonable time. This is essential because auditors need to examine financial information and supporting documents during the audit. Second, the auditors have the right to receive information and explanations necessary to perform the audit. In other words, management must cooperate with the auditor. Third, auditors have the right to receive notice of any general meeting of the company members. And not only that, they also have the right to attend these meetings. If necessary, the auditor can speak at the meeting on matters that concern them as auditors. For example, if there are issues relating to the financial statements or the audit process, the auditor can raise them directly with the shareholders. Another right is that the auditor must receive copies of any written resolutions of the company. This ensures that the auditor stays fully informed about the information about the important company decisions. Okay, now let's look at the auditor's rights when they resign. Even after resigning, auditors still have certain protections. For example, they can request that the company holds a general meeting. At that meeting, the auditor can explain the circumstances surrounding their resignation. This helps ensure that shareholders hear the auditor's perspective, especially if there were disagreements with the management. And the auditor can also require the company to circulate the statement of circumstance relating to their resignation. Again, the goal here is transparency and accountability. Finally, let's talk about the auditor's duty. The primary duty of an external auditor is actually quite simple to understand. Their job is to audit the financial statements and then give an opinion on them. Specifically, the auditor must state whether the financial statements give a true and fair view of the company's financial position. In some countries, this may be phrased slightly different, such as saying the financial statements are fairly presented in all material respects. But the idea is essentially the same. The auditor is providing independent assurance to users of the financial statement, such as investors, lenders, and regulators. In addition to this main responsibility, auditors may also have extra reporting duties required by national law. For example, they need to confirm that the financial statement have been properly prepared according to the relevant laws and regulation. Uh, okay. Now, let's move to another very important topic in audit regulation, the International Federation of Accountants, also known as IFAC. Auditing happens all over the world, right? Companies operate globally, investors invest internationally, and financial information crosses border every day. So the question is, how do we make sure auditors across different countries maintain the same professional standards? This is where IFAC comes in. The International Federation of Accountants, or IFAC, is basically the global organization for the accountancy profession. Its main goal is to promote strong and consistent regulation of accountants all around the world. IFSC works to ensure that there are minimum standards for professional accountants globally. For example, IFSC helps to establish guidelines relating to accountancy qualifications, post qualification experience, and guidance on accounting and assurance for accountants around the world. There will be greater public confidence in the profession as a whole. And remember, trust is extremely important in auditing because users rely on the auditors to provide credible and independent assurance. Now let's talk about International Standards on Auditing, also known as ISAs. Within IFAC, there are several boards that focus on specific areas. One of them is the International Audit of Assurance Standard Board, commonly known as IAASB. Uh, the IASB is responsible for developing and promoting the international standards on auditing. In simple terms, the IASB writes the rules and guidelines that auditors should follow when conducting an audit. Currently, there are 37 international standards on auditing, along with two international standards on quality management. But don't panic, for the ACCA exam, not all of these standards are examinable. ACCA actually provides a list of examinable standards on its website. Another important point for the exam is this: you do not need to memorize the names of numbers of the ISAs. Instead, what the examiner really expects is that you understand and can apply the key principles and requirements of the standard. Okay, so quickly just let me take a water break. Alright, let's continue with our discussion on International Standards on Auditing, or ISAs. Now, here's an important point to remember. ISAs are mainly written in the context of of auditing of financial statements, but does that doesn't mean they are limited only to that. In many situations, the same principle can also be applied when auditors are reviewing or auditing other types of historical financial information. So the standards are flexible enough so to be used in different assurance engagement, not just a standard financial statement audit. Another key rule is that auditors are expected to apply ISAs in almost all situations. In fact, auditors must follow ISAs except in very rare or exceptional circumstances. Now, you might be wondering what happens if an auditor decides not to follow a particular ISA. If the auditor believes that departing from an ISA is necessary to achieve the overall objective of the audit, they can do so. But, and this is important, the auditor must clearly justify their decision. In other words, they must be able to explain why the departure was necessary and appropriate. This ensures that auditors do not ignore standards without a valid reason. Now, let's also quickly look at how ISAs are structured. First, each ISA usually contains three main components. First, the basic principles and requirements. There are core rules that auditors must follow during the audit. Second, the application material. This section provides practical guidance on how auditors should apply those requirements and in real situations. And third, additional explanatory material which helps clarify the intent behind the requirements. This structure makes the standards much easier for auditors to understand and apply in practice. Uh, Now let's understand the relationship between international standards and national regulations. Even though IFAC develops international guidance, it is important to remember something. IFAC itself does not have legal authority within individual countries. So, national governments and regulators are responsible for things like regulating auditors and audit firms and implementing the auditing standards within the country. Because of this, the national standard setters may take different approaches. For example, they might develop their own auditing standards and ethical standards, or adopt international standards on auditing, sometimes with modifications to suit national requirements. Now, here's an important rule for the exam. If there's ever a conflict between international standards and local regulation, then the regulation, I'm sorry, my handwriting is very bad. The local regulation will always win. Let's quickly take a look at the UK as an example. In the UK, the main regulatory body overseeing the financial profession is the FRC. The FRC is responsible for supervising and regulating the auditing profession in the UK. Within the FRC, there's a specific division called the Audit and Actual Regulation Division. This division is responsible for several key activities. Okay, guys, I just quickly glanced at these paragraphs. These paragraphs are not relevant to your exams or are not important. So you can just quickly read them for your understanding, but I won't be touching them in this video. So let's move forward and talk about the role of professional bodies. Professional bodies such as ACCA and ICAEW play a very important role in maintaining quality and professionalism. Um, they do that in several ways. First, they provide rigorous professional qualification. These qualifications ensure that accountants and auditors develop the technical knowledge and skills needed to provide a competent professional service. Second, professional bodies provide support and guidance to their members, um, helping and them and maintain high professional and ethical standards. And third, they provide technical expertise to governments on matters relating to accounting, auditing, and business regulation. This means professional bodies often contribute to the discussion about new laws and regulations, helping shape the future of the profession. Now, let's quickly look at how someone becomes a member of these professional bodies. To obtain membership in an organization like ACCA, a person usually needs to meet three requirements. First, they must successfully pass the professional exam. Second, they must demonstrate relevant practical work experience. And third, they must complete the ethical assessment to show they understand professional ethics and responsibilities. But becoming a member is not the end of the journey. To maintain membership, accountants must complete continuing professional development, also known as CPD. CPD ensures that professionals keep their knowledge and skills up to date, especially because accounting and auditing are constantly evolving. In addition to CPD, members must also follow a professional code of ethics and conduct. Um, this ensures that accountants and auditors continue to act in a professional, ethical, and responsible manner throughout their careers. Um, Professional bodies have strict disciplinary systems in place. If a member is found to have violated their rules or professional standards, um, their disciplinary action will be taken. This type of action depends on how serious the issue is. For less serious breaches, the body might issue a reprimand, which is basically a formal warning. And in some cases, the member may also required to pay a fine. In the issue is more serious, the member could be suspended from the membership or for a certain period of time. And in most serious cases, the professional body may even withdraw the member's membership completely. In other words, the person could lose their professional qualification. Now, most disciplinary matters are usually handled internally by the professional body itself. For example, if an ACCA member breaches professional standards, ACCA will normally investigate and deal with the issue directly. However, if the situation is considered very serious, especially if it involves major public interest concerns, the case may be referred to the national regulator. At that point, the matter moves beyond the professional body and may be dealt with at a higher regulatory level. This ensures that serious misconduct is properly investigated and addressed. The reason this disciplinary system exists is actually very important. By having some strict entry requirements, continuous monitoring, and strong disciplinary procedures, professional bodies can help ensure that accountants maintain high professional standards and ultimately this helps achieve one key objective: maintaining public trust in the profession. Because when investors, business, and the public know that accountants are properly regulated and held accountable, they are more confident in the reliability of the financial information. So this was it for this video, guys. Thank you so much for watching. If you found these videos helpful, please do like and subscribe and share it with your friends to help them better, and follow for more such videos and content. Thank you.